Ever wish you could just cut through the jargon and get straight to the heart of a company's performance?
Like a shortcut through a massive report.
Exactly. Well, today, that's what we're doing. We're taking a deep dive into TD Bank's 2024 annual report.
Yep. Think of this as your quick guide to understanding their key business drivers, how they did last year, and what they're planning for the future.
We'll be focusing squarely on that TD Bank annual report for 2024.
Our mission really is to pull out the most important insights for you.
Performance, challenges, plans for shareholder value, all the crucial stuff, but, in a manageable way.
Without the information overload.
Precisely. Okay, so let's start by unpacking how TD Bank is actually structured. How do the different parts of the business stack up?
Right. TD operates through several main segments. If we look at their adjusted net income for 2024, Canadian personal and commercial banking is the biggest chunk.
How big?
About 50% of the total adjusted net income. Then you've got wealth management and insurance at 23%. U.S. retail comes in at 20%, and wholesale banking makes up the remaining 7%.
That's interesting when you compare it to the year before, 2023.
Definitely a shift.
Canadian P&C was higher then, right? Like 56%.
It was, yeah. And U.S. retail was also a bigger slice at 25%.
But look at wealth management and insurance jumped from 14% to 23%. That's quite a leap.
It really is. Wholesale ticked up a bit too, 5% to 7%.
So what's going on there? Why the change in the mix? Wealth management really standing out?
Well, it suggests maybe a stronger focus on businesses that generate fees, wealth and insurance, diversifying away from just relying on interest income from loans, perhaps.
Makes sense. Less reliance on interest rates, maybe?
Could be part of it. And maybe some specific successes in wealth management. Let's look closer at the segments, starting with Canadian personal and commercial banking.
Yeah, the biggest one. What were they focused on?
A lot about customer and employee experience. They mentioned TD Mortgage Direct, saying it had record engagement and high mortgage volumes, probably helped by their digital efforts.
Okay, digital focus. Anything else?
They got recognized for customer service, again, in an Ipsos study. And they're expanding specialized services in business banking.
Like what?
Like TD Innovation Partners, which is specifically aimed at helping tech companies.
Targeting a growth sector.
Exactly. And they also talk about this one TD strategy.
Right, I saw that mentioned. What does that actually mean in practice?
It's basically about getting different parts of the bank working together more closely. The report mentions putting senior private bankers from wealth inside commercial banking centers.
Oh, interesting. So a business owner could get commercial banking and wealth advice all in one place.
That seems to be the idea, making it more seamless for clients with complex needs. They're also using AI and a new agile operating model called NUW for efficiency.
Neat W.
Okay.
Yeah, plus ongoing investment in core tech, new credit platforms, servicing platforms, CRM systems, standard modernization stuff, but important.
Got it. Now, shifting south to U.S. retail, the report seemed a bit lighter on specific initiatives there, but obviously, the elephant in the room. The AML program resolution. Absolutely. You can't talk about U.S. retail in 2024 without talking about that.
How much did that impact things?
Massively. The charges tied to settling those anti-money laundering investigations hit the U.S. segment's profitability hard and dragged down the bank's overall results, too.
So that explains a big part of the drop in its contribution percentage.
For sure. The report does briefly mention restructuring the U.S. balance sheet, but doesn't go into much detail in this section.
Okay. Let's move over to wealth management and insurance then. That segment saw some real growth in its share of income. What were they doing?
Seems like they were focused on expanding their reach and services. For instance, getting U.S. licenses for Canadian investment advisors to serve clients cross-border.
Smart move, tapping into that market.
Yeah, and offering financial plans in more languages. TD Asset Management, or TDM, launched new mutual funds and ETFs too.
Broaden the product shelf.
Exactly. And on the insurance side, improving digital self-serve options. Plus, they mentioned strong referrals coming from the personal and business banking teams.
That one TD thing working in reverse, maybe.
It could be. And TDM also won some big mandates from institutional investors around the world. So a lot of positive momentum there.
Okay, and the last piece, wholesale banking. Smaller segment, but what's the story?
Seems focused on strategic growth and ESG, environmental, social governance. They highlighted a multi-year investment in global transaction banking, or GTB.
And is that paying off?
Apparently so. They reported a 25% jump in corporate deposits from that initiative. That's significant.
Definitely. And the ESG angle.
They're active in advising clients on ESG matters and providing financing solutions, like working on major social and green bond deals. They also flagged involvement in big corporate transactions, tech resources, TMX Group, Advantage Energy. So quite active.
So lots happening across all segments. But it wasn't all smooth sailing. The report definitely flagged some major challenges in 2024.
Oh, absolutely. The big one, as we've mentioned, was that huge charge, $4.233 billion for the U.S. AML resolution.
Ouch. That's a big number.
A very big number. On top of that, non-interest expenses were up generally.
Why was that?
Investments in risk and control systems likely linked to the AML issues, but also technology spending, employee costs, marketing. It all added up. And higher costs in the insurance business, too.
Okay, so those were the main headwinds. Let's dive into the actual financials now. What are the key numbers we need to know for fiscal 2024?
Well, the bottom line, reported net income came in at $8.8 billion.
Which was down from 2023.
Yeah, down 17%. But, and this is crucial, if you look at their adjusted net income, which strips out things like that big AML charge, it was $14.3 billion.
Okay, and how does that compare?
That was down 5% from 2023. So it's still a decrease, but much less dramatic than the reported figure suggests. You really have to look at both numbers.
Right. So besides the AML charge, what else pushed the results down, even on an adjusted basis?
Well, those higher non-interest expenses we just talked about. Risk, tech, people, marketing, also higher insurance service expenses, and a higher provision for credit losses, or PCL.
PCL, that's the money banks set aside for loans that might go
bad, right? Exactly. They increased that amount, suggesting maybe a bit more caution about the loan book. But offsetting some of this pressure were higher overall revenues.
Okay, some positives too.
Yeah, and the significant gain they booked from selling shares they held in Charles Schwab.
Ah, okay. Can we break down the revenue side a bit more? Where did the money come from?
Sure. Net interest income, the bread and butter, earning more on loans than paid on deposits, was $30.472 billion.
And non-interest income, fees, trading, etc.
That came in at $26.751 billion. And that figure includes that gain from selling the Schwab shares, which was just over $1 billion, $1.022 billion.
So the Schwab sale was a big boost to non-interest income.
It was, but other things helped too. Reinsurance recoveries, higher income from lending activities beyond just interest, more underwriting fees, better trading results, and growth in fee income from wealth management and insurance.
Adding all that up, what was total revenue?
$57.223 billion for the year.
And the PCL number, how much was set aside?
The provision for credit losses was $4.253 billion. That was an increase, reflecting, as the report says, credit migration, basically, a slight worsening in credit quality in both Canada and the U.S.
Okay. And we already covered the net income figures reported and adjusted. What about the bank's overall financial strength? How did the balance sheet look?
Pretty solid, generally. Total assets grew, crossing the $2 trillion mark to $2.06 trillion. That's up from about $1.96 trillion.
Wow. And deposits.
Deposits also increased, reaching $1.269 trillion. Equity, which is like the bank's net worth, rose to $115 billion.
What drove the equity increase?
Mainly gains in something called Accumulated Other Comprehensive Income, or AOCI. Think of it as capturing value changes that don't flow through the main income statement immediately. However, this was partly offset because retained earnings were lower.
Why were retained earnings down?
Mostly due to paying dividends to shareholders and buying back the bank's own shares.
Right. Now, what about those capital ratios, the key measure of safety?
The main one is the Common Equity Tier 1 ratio, or CET1. It measures the bank's highest quality capital against its risk-weighted assets. Basically, it's buffer against losses.
And where did TD land?
13.1% at the end of fiscal 2024.
How does that compare?
It's down from 14.4% at the end of 2023. Still a very strong ratio, well above regulatory minimums, but lower.
What caused the decrease?
Several things. The hit from the AML charges, the cost of share buybacks, growth in risk-weighted assets as the bank grew, and some regulatory adjustments. Offsetting that was the capital the bank generated internally from earnings, plus proceeds from selling those Schwab shares and also shares they held in First Horizon.
Okay, a lot of moving parts there. What about cash flow? Did the report give much detail?
Not in the sections we focused on, but we do know that Schwab share sale brought in about $3.4 billion in cash. Generally, you'd expect a bank like TD to generate significant cash from its operations to fund its investments, pay dividends, and do buybacks. That's key for financial health.
Speaking of dividends and buybacks, let's talk about how TD plans to create value for its shareholders. Any specific actions mentioned?
Yes, a key one is the dividend increase. They announced a hike of 3 cents per common share starting in the first quarter of fiscal 2025.
That sounds like a signal of confidence despite the challenges of 2024.
Absolutely. It suggests management feels good about the bank's underlying earnings power going forward.
And share buybacks, do they continue?
Yes, the report confirms they did repurchase shares during the year, which contributed to that dip in retained earnings we mentioned. It's also worth noting there's that new 2% federal tax in Canada on share buybacks now, which affects the net impact.
Right, Bill C-59. And how do they measure the overall return they're generating for shareholders?
A key metric is return on common equity, ROE. For 2024, the reported ROE was 8.2%.
Which reflects that big AML charge.
Exactly. The adjusted ROE, which smooths out items like that, was much stronger at 13.6%. Still slightly down from 14.2% in 2023, but a solid return.
And they'd also look at the dividend payout ratio, how much of their earnings go out as dividends.
Correct. That shows how sustainable the dividend is relative to profits.
Okay, so pulling back for a wider view, based on this report, what's the assessment moving forward? What's the outlook?
Well, they're expecting the Canadian economy to pick up modestly in fiscal 2025, helped by gradual interest rate cuts. They think their net interest margin, the profitability of their lending, should be relatively stable in the near term, Q1 2025.
Any potential headwinds flagged for the near term?
They did mention PCL, the provision for credit losses, might see some further increase, and a big focus will be on prudent expense management.
Watching costs carefully.
Definitely. While also continuing to invest in distribution, technology, and importantly, risk and compliance infrastructure, especially in Canadian banking. They do caution that even with a somewhat supportive economy, they might see some pressure on operating leverage.
Meaning costs might grow a bit faster than revenues?
Potentially, yeah. Balancing investment with cost control is always tricky.
And what about the major risks and challenges they see ahead?
Number one is undoubtedly the ongoing remediation of the U.S. AML program. They state clearly it's a multi-year effort.
And if they don't meet expectations?
There could be further consequences, potential limitations on asset growth, delays in launching new products or services. They expect a monitor to be appointed in 2025 and have timelines for fixes. It's a huge focus.
What other risks are on their radar?
Increased regulatory scrutiny generally, across the board, not just AML, geopolitical risks, economic instability, new laws and regulations, risks from relying on third-party vendors, and various operational risks, including those tied specifically to the AML remediation work itself.
So a complex environment.
Yeah.
But what about their strengths? What are the opportunities?
TD still has major strength. A very strong capital and liquidity position gives them a solid foundation. Deep customer relationships are a huge asset.
And leadership in certain areas.
Yes, like TD Direct Investing in Canada, their digital capabilities are generally strong, and they highlight their commitment to sustainability, both in finance and social initiatives around financial access, housing, and employment.
So boiling it down, what are the key priorities for 2025?
Based on the report, it's clear. Successfully execute the AML remediation plan, manage expenses tightly, keep making targeted investments in growth and tech, and navigate that evolving regulatory and economic landscape.
Okay, so let's try to summarize this deep dive. TD Bank navigated a really challenging 2024, heavily marked by that U.S. AML resolution.
Yeah, reported earnings took a hit because of it.
But the underlying business, looking at adjusted numbers and the balance sheet, still seems pretty robust. They've got strong capital.
And they're continuing to invest in the business, in customer experience, and technology. Plus, they signaled confidence with that dividend increase.
Right. So the path forward seems to be about managing these ongoing regulatory issues, especially in the U.S., while executing on their strategies.
Exactly. It's a balancing act.
Hopefully this conversation has given you, our listener, a clear, comprehensive picture of TD's recent year and where they might be heading. That well-informed feeling without getting lost in the weeds.
Absolutely. And it does leave you with a thought, doesn't it? Considering the sheer amount of investment and focus going into AML compliance.
What's the thought?
How might that fundamentally reshape TD Bank's appetite for growth, particularly certain kinds of growth, and their overall approach to risk in the coming years? It's a massive undertaking.
That's a really important question. How does this intense focus on compliance potentially change their strategic DNA moving forward. Definitely something to watch.
For sure. And as always, the full annual report has much more detail.
Yes, if you really want to go deeper, the risk factors and management's discussion and analysis sections are where you'll find a lot more context.